So there are multiple reasons why the GCC is more prevalent in India, and one of the reasons is definitely large skill pool of people, the cost efficiency, the price at which the skill talent we are getting in India as compared to the abroad, definitely there's a differential. Strong IT and digital ecosystem, the time zone advantage, you can simultaneously serve to the US as well as Japan. So this is the specialty of India. Then English proficiency, we definitely, from this I remember the one famous dialogue of a movie dialogue. I can speak English, I can walk English, I can talk English. So that's a famous the Hindi movie dialogue, which remind me the specialty of India. So I'm coming to the topic, why GCC in India? So the next topic is the tax planning and the structuring of GCC. And for that, we have a speaker, Mr. Gaurav Bhauwala. He is a corporate tax partner from Deloitte, India, with experience of more than 17 years in tax advisory, compliance, and controversy management. Is having extensively advised GCC and GIC on India entry strategy, funding structure, operating model expansion, entity rationalization, and exit strategy. Gaurav is also specialized in India tax and exchange control compliance, assisting multinational organizations in managing complex reporting and regulatory requirement. By profession, he is a chartered accountant and hold a bachelor degree in from commerce from Bangalore University. So welcome you, Gaurav. With a huge round of applause, I request everyone to welcome Gaurav. So we're happy to present Memento to Gaurav. So over to you, Gaurav. All yours. Thank you.
Thank you, Rakesh. And good afternoon, everybody. And thank you for being here. And thank you, WIRC, for hosting me today for this event. So over the last 2-3 decades, and I'm sure you all have heard about this since morning, India has been established itself as a global destination and a preferred destination for setting up GCCs. And if statistics is to go by, about 50% of the GCCs today are based out of India from a global footprint standpoint. And what has evolved significantly is over the years from being a simple cost-efficient back office support center, today India is housing GCCs which undertake strategic roles in terms of innovations, in terms of technologies, in terms of analytics, in terms of finance, tax, and overall enterprise transformations. India today houses thousands of GCCs supporting global operations across sectors. And this momentum is only going to continue in the coming future, and therefore it becomes extremely important for all the GCCs to be familiar with the India tax and regulatory landscape. Today, with you, I will walk you through a few of these key tax and regulatory considerations that one has to bear in mind, the emerging issues that today organizations are navigating, and practical considerations that one will have to keep in mind while building and operating a GCC here in India. So before we get into the aspects of the tax angles, I thought I'll just share with you some data points in terms of where the GCC today is and where it is expected to be in the coming future. So again, like I mentioned in the earlier part of my session, India houses about 50% of the GCCs across the world. That number from a number perspective is about 1,800 today, employing about 2.1 million or 2 million people, contributing about $65 to $70 billion, and that translates to a little over 1% of India's GDP. This, by estimates, is estimated to become 2,500 GCCs by 2030, employing about 2.5 million people directly and about 5.7 indirect employment, something which our fellow colleagues and panelists spoke in the previous sessions. And this growth is going to come from multiple areas. Now, today it's no longer just the metro cities. We are seeing the developments of emerging cities like Kochi, Coimbatore, Trivandrum, Mysore, Mangalore, Chandigarh, to name a few. And with those data points, one thing was very clear, that the GCC as a sector contributes to India's growth and economy to a significant effect. And that is going to continue to be so in the future, and it's going to be a game changer. And doing this, and by the government of India is also recognizing the importance of the GCCs, and they are taking multiple steps to make sure that they provide the necessary impetus that the industry as such needs. And 2-3 key points that I'd like to share with you in today's session is about an event that the central government hosted with the help of CII sometime in July 2025, where our Honorable Finance Minister Nirmala Sitharaman held a meeting with key GCC stakeholders. The idea was to just get a sense of what their feedback is in terms of what should India as a government do to contribute to the overall growth journey. So few key suggestions that came out from that particular meeting was that our talent, even though today is top class, can be even better by aligning the talent requirements with what the industry requires. So a collaboration with universities and GCCs was something which was coming up as a suggestion. The regulatory support, introduction of a single window clearance. Today, if one has to set up a shop in the form of a GCC, there are multiple approvals you need, and you need to approach multiple regulators. So to avoid that, and if we can have a single window clearance, something similar to what we see in the IFSC space, is something which was again coming out as a recommendation. And a unified GCC framework, have a broad master plan in terms of a GCC policy, under which the states can introduce their respective GCC policies. And in doing so, everyone again recognizes the fact that, GCCs contribute to the overall economy, not just from a central perspective, but even from a state perspective, and leads to an employment generation. So multiple states have introduced their own GCC policies, and to name a few, these are what you would see today which are active. The Karnataka GCC policy, the UP, Maharashtra, Madhya Pradesh, and Gujarat, to name a few. Right. So now, coming from a tax perspective, when a multinational or any other organization is looking at setting up a presence here in India, especially in the form of a GCC, it's important to bear in mind the key tax and regulatory considerations that will determine their overall operating models. So these are a few key typical points of considerations that one will bear in mind. Starting off with a holding structure. How should the GCC be set up here in India? Should the investments come directly from the main parent entity, or it should be interposed through an intermediary? And this is not purely a tax issue, but it's also dependent on the overall philosophy of the multinational enterprise in terms of how would they like their investments to be held. For example, a lot of multinationals who have a presence across the world will segregate their businesses into different geographies, EMEA or APAC region, or they may have a direct holding from US, for example. So those considerations will also bear in mind in terms of how should the particular Indian entity be structured as, either as a direct holding or through an intermediary. Another point that will bear in mind is the availability of treaty networks. Like if I come down directly from, say, US, would I be better off from a treaty perspective, or coming through, say, EMEA entity, say Netherlands or UK, for example, which provides a little better treatments from a tax perspective, or if it is an APAC hold company, whether coming through Singapore makes sense. Right, so these are multiple considerations that one will bear in mind while determining how should the Indian entity be structured as. I'll just come to this. Then comes the choice of entity, and again, our panel members spoke about this in the earlier sessions, that you broadly have two choices. You either set it up as a company or as an LLP. The tax considerations associated between these two choices would be looking something like this. Like when you look at it from an overall ETR perspective, an LLP is subject to a 35% corporate tax rate, while a company is typically subjected to a 25.17% tax rate. CSR, corporate social responsibility, which mandates you to contribute 2% of your average profits for social causes, are applicable currently only for a company, which is a cost, it's not tax deductible. LLPs are not subjected to that requirements. Once you have your post-tax profits, from an LLP structure standpoint, profits repatriated to a partner are not taxable. There is no distribution tax, either in the hands of the LLP or in the hands of the partner. When you contrast that with a company form of a setup, the company will pay a corporate tax rate of 25.17%, and the post-profits after tax, the typical way of repatriating would be in the form of dividends that will attract a withholding tax. Now, while under our domestic tax laws, it is at about 20%, but under the treaty year, for simplicity, I've considered US, which has about a 15% withholding tax rate. So your ETR, by and large, is quite similar when you look at it when from a LLP and from a company standpoint. In terms of funding, once we've determined how we should be structuring the entity, how in what form and shape we will take it as, the next choice will be is in terms of how do you fund this entity. Broadly, there are three options. You can fund the entity in the form of equity, or you can get them as external commercial borrowings, which is popularly called as ECBs, foreign debt, or you can have something called as a advance against services. Now, typically, and a GCC is going to render services only to its overseas group companies. And if it is in an international context, these are generally structured as a cost-plus entity. And therefore, they will have the need to regularly bill them and bring in the money into India. So one way of funding those working capital needs is to get an advance against services. And these are the three broad forms through which you would typically see a GCC being funding. Equity, while it's the most simplest form where there are no end-use restrictions, it does come with its limitations in terms of tax inefficiencies, because each time you repatriate profits in the form of dividends, it'll attract a withholding tax rate. And if you're looking at exiting, it'll attract a capital gains tax. While debt, the interest is the only source of return for the lender. That interest, again, can be subjected to a withholding tax rate at concessional rates under the treaty. It is tax deductible for the Indian entity that is borrowing the money, subject to the thin cap rules. And it's slightly regulated from an exchange control standpoint. There are certain end-use restrictions, although fairly liberalized in the recent amendments. And working capital advances, as I just mentioned, that is the most simplest form of infusing. Now, there can't be a clear solution in terms of what is an ideal structure. It has to be a combination of these three. And you will never be able to identify only as one being the only way in which you would see a GCC being funded. In our experience, we've seen a combination of these three happening. Generally, you would infuse very little equity capital, and you will fund the rest in either in the form of debt or in the form of advance against services. So talking about the incentives that the government of India and the state governments offer to a GCC setup. Broadly, if you look at it, the fiscal incentives can be broken down into central policies and the state policies. The central policies are more in the form of income tax exemptions or GST-related concessions. The state policy incentives are in the form of reimbursements of operating expenses or subsidizing your operating expenses or subsidizing your capital investments. There are certain conditions with respect to these incentives in terms of what is your project size, what is the level of employment you will be bringing on to the project, where are you hosting or locating this particular project of yours, and basis that you make those applications and you broadly get these kind of incentives over a period of time. I just spoke of this. So the incentives from a state perspective are broadly three, that the capital subsidies, which will be a return on the investments that you make. Operating subsidies could take in the shape of stamp duty, concessions, reductions in lease rentals, electricity duties, power subsidies. And from an employment generation perspective, the employee contributions towards provident funds and the likes of those are typically reimbursed by the state governments. And these are a few state incentives that you would typically see in terms of what they would offer to you. This is just a key snapshot of the various kinds of incentives that each project would provide you, ranging from capital subsidies to skill incentives and lease rentals. The other emerging ones which we've seen this being discussed multiple times today is on the IFSC regulations. From a GCC standpoint, you would broadly again see two kinds of regulations that would be applicable to them. The first one would be is the BATF regulations, popularly called for bookkeeping, accounting, taxation, and financial crime. Now, as the word suggests, IFSC, you would typically associate organizations in that particular area to be in the financial services sector. But this regulations is unique to that extent that anybody can set up a BATF license or obtain a BATF license and undertake activities from this, and it is industry agnostic. It need not necessarily be in the financial services sector. You can host a GCC in a IFSC gift city, get your licenses under the BATF regulations and provide these activities to your overseas clients. The other one is global in-house centers. This will require you to be providing services to your financial group. You will have to provide services in relation to their financial products and services. In terms of the key benefits that the Gift City and IFSC provides to units being set up there, the key takeaways would be is a 20-year 100% tax holiday on your income taxes. You will not pay any alternate minimum tax or a minimum alternate tax. Your dividends, if you're structured in the form of a company, will attract a withholding rate of only 10% as against 20% that is typically charged under the domestic tax laws. Again, if you are structured as an LLP, there is no tax on repatriation as well. You get various other forms of indirect tax incentives in the form of no GST applicability on your exports and as well as on your imports. Your customs duties are exempt, and in certain circumstances, your security transaction tax and your commodities transaction tax are also exempt. In terms of corporate law, also there are certain relaxations. You will not be subjected to CSR for the first 5 years, and many other such concessions. And the one on your extreme right is the state incentives that the government of Gujarat provides for setting up a center in the gift city. Now, a key teething issue that you would typically witness a GCC struggling with historically was the transfer pricing margins. As we've all spoken about this, that a GCC is typically structured as a captive service, a risk mitigated entity, and it's generally compensated on a cost plus model. And this is where the controversies typically were there, where there was a dispute in terms of what the arm's length margin should be, while we as taxpayers would offer anywhere between 10% to 18% depending upon the kind of activities we undertook. The transfer pricing officers would allege higher margins leading to higher tax demands, and this would typically get locked up in litigations for a number of years. Then there was this alternate dispute resolution that came in the form of an advanced pricing arrangements, where taxpayers could get certainty by sitting across the table with the tax office and negotiate in terms of what the arm's length price should be for a definite period of time. And that again, depending upon our fact profiles and what kind of activities one would undertake, it would range anywhere between 16 to 22%. Now, in the recent budget, recognizing that this is a teething issue and it's causing a lot of heartache to the MNC community, especially the GCC community, the safe harbor rules were amended and broadened to provide two key takeaways from those regulations. One is that the thresholds for the applicability of the safe harbor rules for taxpayers increased from a certain 100 crores to 2,000 crores of revenues, and the margins were down to 15.5%. So this change and this amendment will now significantly reduce the disputes that taxpayers would typically undergo. And this is a welcome move in terms of bringing in certainty and stability into the tax systems. The other two typical issues that you would witness with a GCC setup is the risk of a permanent establishment being created. Now, how many of us here are familiar with this concept, permanent establishment? Right, great. So, for the benefit of all, in a quick snapshot, a permanent establishment typically is a concept that comes from the treaty. And what it really tries to say is that a foreign enterprise having a presence in India leads to a taxable presence. And when that happens, the profits that are attributable to that presence and that activities that the foreign enterprise carries on will be taxable in India. And that's, of course, not something that anybody would want to be ceding to. And therefore, we need to be extremely cautious. And this is a topical fact pattern with any GCCs that you work with. Now, when you set up a new GCC, you will see that they send their expats into India. And they come down to India to undertake certain defined functions, to basically set processes into India, making sure that the people here in India understand the manner in which it's supposed to be undertaken, the work, the quality standards, the review standards, and the overall work that is being done here in India is as per their international standards and protocols. And when they come here in India, the expats, is when there is a risk of those expats deeming to be having created a PE in India. Now, to navigate this and to mitigate this risk, it's extremely important for them to have a well-drafted secondment arrangement in place. Because here even our judiciary is kind of divided on this. You will see that you have enough number of case laws to attribute that secondment of expats do not create PE. while on the other side you will see a few jurisprudence which have gone on to say that presence of expats in India create a PE. So it's extremely important to make sure that the secondment arrangement and the secondment agreement is drafted to basically draw home 3-4 key points, that when this expat is in India, he is under the direction, supervision and control of the Board of Directors of India. He is carrying on the work of India, right? And at no point in time he is being here in India as an employee of the foreign enterprise. Right? Now, how do you determine that he's an employee of India? So there is this concept called economic and legal dependence. So when the expat is being paid his salaries by the Indian entity, you will say that he's economically employed by the Indian entity. And when is he said to be legally again employed with this entity? When his payroll is here in India, he is subjected to the rules and regulations and the HR policies of India. It is during this time when he is in India, the board of directors of the Indian entity basically have a right over his appraisals and promotions. Right? So when our secondment arrangements and agreements are drafted in that manner to showcase that this expat, while as in India, is working for the business of the Indian entity under the direction, supervision and control of the Indian entity, you would typically ring fence and mitigate any kind of a PE risk, even if it is alleged by the tax office. The second typical fact pattern you would see in a GCC setup is that a GCC would typically undertake two broad activities, IT, ITES, and marketing support. By marketing support, what I really mean is that you have a product of the overseas entity. There are potential market and customers here for that product in India. Now, the overseas entity can't reach the customers, and therefore they will have a team of marketing support specialists in the Indian GCC. Their job is to basically act as a channel of communication, and their jobs are typically to go and identify where the target is for these kind of products, have meetings with them in terms by disseminating information about the product and giving them demos about the product. And if a particular customer is happy with that product and is looking to subscribe or buy that product, is when he acts as a channel of communication between the customer and the head office. Now, in these kind of situations, you would again typically see the tax officers alleging that these activities that the marketing team is undertaking is beyond that. And many a times they would go to allege that these folks are actually concluding contracts. They are the ones who are negotiating the terms of the contract, and they are playing the principal role leading to the conclusion of that contract. And in those situations, these marketing folks would create a taxable presence for the overseas entity. And the implication of that is that the tax officers would allege that there is a PE, and therefore the profits attributable to that sale should be taxed in India. And for the benefit of everybody here, a foreign enterprise is taxed at 35% on net income basis, which is a huge number. And therefore, it's extremely important that again, when a GCC is looking at undertaking these marketing support services, they do make sure that they do have these checks and balances in place and make sure that they do not do any activities beyond what is permissible. You would typically see in a GCC setup, the sales office teams, especially the senior guys, projecting themselves on social media platforms like LinkedIn as APAC sales head or EMEA sales head. Now, these are typical recipes for the tax office to use it against the Indian taxpayer itself. And again, and therefore we as professionals should be mindful of that and educate our clients to ensure that those usages of those terms and jargons should be avoided when it's not factually true, because tax laws again have gone on to hold that if a particular person projects himself on a social media platform, that can be used against him. Right? So these are typical do's and don'ts that you would see, that you would recommend your clients to adhere to. This is the last part of my session. These are the typical compliances that you would see, again, a GCC undertaking, starting with indirect taxes. You'll have your monthly filings, your annual filings, and you will claim your refunds. And from a direct tax perspective, you would undertake withholding returns, annual filings, be it your withholding returns as well as your income tax returns, and likewise, your transfer pricing and Indian exchange control compliances. Thank you so much, and it was lovely being here.
So thank you, Gaurav, for the nice presentation. A huge round of applause for Gaurav. So we have some time. If anyone has any questions or any doubt which he want to clarify, Mike, please.
Gaurav, this is Sneha, and maybe a question on the permanent establishment. Generally, not restricted to only marketing support, but to an extent wherein we are into supply chain and procurement stuff under the GCC umbrella. What guidance could it be to avoid a PE risk as usual as we are carrying all the time, taking active decision making within the center?
So, in the context of procurement or etc., like the GCC is doing this as a service, right? There's a contract of service between the overseas entity and the Indian entity, pursuant to which the Indian entity is undertaking these services, right? Now, if there is a standard guidelines and a SOP of sorts which has been provided to the Indian entity that if, these are the documents that is required from a processing of a payment. If those documents are there, process it. If those documents are not there, reject it. Then it's basis the guidelines that the overseas entity has provided them is what they are processing as a service. And that could be done by anybody, right? Like you could outsource it to a third-party service provider also. So if you're doing that within the overall framework and those guidelines that you've got from your head office, I don't see a reason why that activity per se here would create a PE.
Okay, thank you.
Hello, yeah. Good evening, Abhinav this side. I'm a member from the industry. Thank you, first of all, it was very informative. I think one of the most technical sessions, we got to learn a lot, and being a member of the industry, for us it is very difficult to find our space between all the practicing chartered accountants. But I think it was very informative technically as well. So I just want to understand if you can just throw some light on how a BOT model works, maybe some taxation perspective, because practically that's something which is evolving a lot in terms of not just the structuring, but in terms of people going from a normal, say, in-house model to a BOT segment. So can you just throw some light there, please?
Yeah, so if I heard you right, you want to understand about the BOT model, right?
Yes, BOT model, taxation perspective.
Right. So look, the whole concept of BOT is evolving, right? And we've seen this and heard this today morning, since morning. Now, there are multiple ways in which this BOT model is typically undertaken. Now, and I can talk about it from my experience. We've seen where a service provider sets up the whole setup and then they transfer that to the client of theirs, right? Or after a period of time. Now, the way I have seen it is of two folds. You do a share transfer, right? That entity itself is acquired by the client of yours now, or you do an itemized transfer or a business transfer, right? Now, if the client of yours is looking at only people, they have their own assets, they have their own technologies, they have their own office space. They are only looking for those trained people who have now familiarized themselves with the whole process. Then you will only look for a employment transfer. But they want the whole setup, lock, stock, and barrel. Then you would typically see two styles, either an share transfer at the entity level or a complete business transfer. The business transfers again can take in two shapes. Either you do a slump sale or you do a demerger. But in a third-party scenario where there is a third-party service provider providing you that service and then you are trying to acquire it from him, demergers will not be suitable because demerger will require you to issue shares as a consideration, and you do not want now the third-party service provider to be a part of the whole system. So you will then do a typical business transfer for a cash consideration.
So, okay, thank you very much. I just invite my council colleague for the formal vote of thanks, Mr. Jitendra Saglani.
So once again, good afternoon, everyone. Friends, I rise with great pleasure to propose a formal vote of thanks for this truly enriching session on tax planning and structuring of Global Capability Center, that is GCCs. Friends, we are deeply thankful to CA Gaurav Bhauwala ji, tax partner at Deloitte, India. He traveled all the way from Bangalore today for this session, and he shared wealth of experience with us. Sir, the case study on PEs was something which was starkable, and we got to know a lot about that through that particular example of yours. And friends, I think as chartered accountants today, this particular session has reinforced the thought that tax structuring is not an afterthought, it's a day zero decision. Whether it is choosing between SEZs, IFSC or DTS structure, or navigating profit, repatriation, and compliance. We as CAs sit right at the center of every decision. Friends, we are thankful to, once again, the leadership at WRC for curating this particular session and having Gauravji here. And I'm thankful to each one of you for patient listening and also the engaging questions. With this, we conclude the session and we're carrying on with the next session. I request Sri Abhishek Dhamne to take charge. Thank you so much.